Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we are going to talk about a couple of ideas that are really fundamental to being a successful investor. During times of market volatility, these principles need to be kept in mind. One principle deals with a deception, a little bit of a deception when it comes to mountain charts that show performance numbers, and they deceive us into exhibiting or acting in a way that actually sabotages our performance in our portfolios. Another chart will show you just how difficult it is to be a successful investor from a stock market standpoint. It doesn't mean we can't achieve success, but if we are not adhering to one important principle, you will blow up your performance in your portfolio. So I think you'll enjoy this video as we unpack these two ideas. If you're new to our channel, make sure you hit the subscribe button so you're not missing future content. And if you like the video, make sure you click like. So the first slide I'm going to show you is both helpful, but it also creates a bit of a deception. So let's take a look at that chart. So the chart in front of you is the historical bull markets and bear markets. For you that are relatively new to investing, a bull market's a good market, a bear market is a bad market. And we're looking at the US stock market, the S&P 500, over the last 75 years. Now when you step back and look at this chart, the green on the chart would be the bull market cycles. The red in this chart here would be the bear market, the poor markets. Now what you see right away when you step back and look at the broad perspective of markets is that bull markets are usually much longer than bear markets, and the rate of growth that you would experience through a bull market is far greater than the loss you experience through a bear market. So that's the first principle of investing. But what happens is, from an emotional standpoint, investors weigh the fear of loss or loss far heavier than the potential for gain or real gain. Investor psychologists often say that could be anywhere from 2 to 4 times more weight to losses than gains. So in your own world, just take a look at that. You know, if you get 1 unit of loss, however you quantify that, you would need probably 2, 3, 4 times that value in gain to be equivalent from a psychological or emotional standpoint. And because of that, as we go through losses, it can create more anxiety and lead us to make some low probability decisions when it comes to our portfolios. On average, bull markets last almost 9 years, and bear markets on average last about a year. Okay, so there's some encouragement there. None of us want to go through these red zones here when the markets are going through a difficult time. But what we need to be mindful of, at some point, economies begin to expand again. So we go through these economic cycles, we go through a repricing of assets, we see a slowdown of economies, but then life begins to go back to a more normalized state, and we see some growth again in the economies, and that will be reflected by valuations in the stock market. But the reason we hear so much about it is that we weigh emotionally those red areas much more emotionally. Now here's the deception in this chart. This chart seems to show us that even if we're going through volatility here and we're a little bit anxious about it, we might be able to sidestep some of this volatility. And even if we miss some of this initial gain in the market, we can capture some of this growth over time and invest in the markets when a lot more of the headline news is positive and we just feel more optimistic about the markets. And a lot of investors exhibit that kind of behavior for sure. Because if you look at inflows to financial assets, they tend to be happening as the markets had some momentum for a while, and you don't see retail investors typically adding a lot to their portfolios during downturns. But from an investment principle standpoint, when it comes to the stock market, you usually want to be a little bit contrarian and add when the markets are down because the sales are on. Again, it's not easy to do. I don't want to come across as not being sensitive to the reality of all of us get anxious, upset, frustrated when we see losses on portfolios that we've worked very, very hard to build. But just keep this in mind. So what happens is people will often, through these bear market cycles, go, this is really crazy. I don't want to go through any more volatility. I'm going to step out of the market and then go back in. So they have to get 2 decisions right. One is leaving the market. When am I going to do that? And the second decision is when I go back in. Because for many investors, they do need stock market returns on a portion of their portfolio to protect themselves against the long-term ravages of inflation and taxes. So having some money in growth assets like stocks, high-quality blue chips, likely makes sense for them. So they have to get back in at some point to get those returns they're striving for. So here's the dilemma. So I'm going to talk about a slide that is both disheartening, but at the same time teaches us a really, really important lesson. So let's take a look at that slide right now. So the slide you see in front of you basically is the Standard & Poor's 500 index over the last 30 years. And so it's a broad U.S. stock market. And what you see is that if you and I put money in the U.S. stock market, $100,000, and we let it just compound over a 30-year period and reinvested all dividends, the portfolio grew to 10.6%. Now, I'm going to go down to the right of this chart and I'm going to show you this bar, and it's missing the best 50 days. So if you and I miss the best 50 days in the markets over that 30-year period, our growth ended up being 1.6%, not 10.6% compounded. And the value of the portfolio is $161,567 instead of $2,081,229. Huge difference. So what this is showing us is that a very small number of days led to most of the growth in the markets. So if I go back to that previous slide, let's just take a look at it. So in this previous slide, if in fact only 50 days led to most of the growth, if you're trying to time this exit from the market and then going back into the market because you just want to sleep at night and you feel like you can kind of time yourself out of some of the volatility and then move back in, this timing decision is very, very difficult because it's a very small number of days that will lead to most of your performance. So let's take a look at another chart that is even more startling. Now, the chart that you see in front of you on the screen is a chart that looks at the best, worst trading days in the U.S. stock market, the S&P 500, between 2008 and 2021. The green bars are the 20 best days, the red bars are the 20 worst days. Now what you see right away in this chart is that the best days and the worst days are concentrated right up against each other. So here's the dilemma. If you're waiting to see headline news that's more positive before you allocate assets back into the market, you're likely going to miss some of the very best days. Some of the best days in the market are right up against some of the worst days. So from a psychological and emotional standpoint, it will be impossible for you to time those days. You will miss those best days if you're trying to wait for a clarion call from the rooftop that now is the time to invest in the market, or you're looking for headline news that is now positive. But usually when that news begins to filter to the top of the story deck on cable networks and broad newscasts and newspapers and websites, it's likely too late. You've missed most of that momentum. Warren Buffett would often say markets climb a wall of worry. And this is essentially what he is talking about. You'll see markets rebounding in the midst of uncertainty. And it's impossible to really time when that's going to happen. That's why if you're working with an advisor and they say, you know what, stay in the market, we'll wait for the rebound, it's going to come at some point, that seems like very superficial, almost hollow recommendations, and yet that is the high probability decision that you need to make in that moment. So a couple of things. Very few days drive most of the markets. That's a challenge. You need to be in the market so that when those days do happen, you can capture that growth. The way you deal with volatility in the markets is not by trying to time your way through volatility. The work you need to do before you go into the investment markets has to be very solid so that you can get through the volatility that's sure to come. Volatility is the way that we make money in the stock market. It comes with the package. And so before we invest in the market, we need to have quality assets. We need to have a diversified portfolio that matches our risk temperament and the kind of returns we're trying to achieve in our portfolio. We need to do our homework. We need to have safe harbor assets. If we need money from the portfolio over the next few years, you want to use high yield cash accounts, T-bills, short-term government bonds, GICs, or term deposits. So you don't have to worry about selling those assets at a bad time if the market has to be down. So you want to do the proper spade work, the homework, to build your portfolio to be resilient prior to a market correction. So when we go through them, which we will for sure go through them at some point, out of every 10-year cycle, 75% of the time the market's up, 25% of the time the market's down. So like I said, it comes with a package. Anyway, I hope that that's helpful to give you some information that you need to be mindful of when it comes to investing. It's very appropriate during the current period given the market volatility that we're going through. And again, if you don't want to miss future content, hit the subscribe button. If you like the video, make sure you click like. And there's also a link to our website. So if you want to start a conversation about your retirement income planning or even getting a second opinion on your portfolio, don't hesitate to reach out to us. You take care. Bye-bye.